What's up YouTube, it's Todd Horst here with Taste Tracker, and today I have another video. Today's video I'll be talking about scaling. I have a couple different topics within the scaling framework. So first I wanted to talk about what is scaling. Scaling is entering more of a position, but it could also be exiting gradually from a position. So the whole point is that you're not entering in all of the number of contracts or buying all of the shares of stock that you could potentially buy, hoping to get better prices and be more effective in your actual trade. So it can be done anytime after open when the stock is down, flat, or up. So an example of that would be is if the stock continues to go up and it is showing more and more strength, you might want a larger and larger position to capitalize on that strong move. It can be done in stocks or options. Some common synonyms that you'll hear thrown around are doubling down, averaging down, laddering in, reducing cost basis, and of course scaling. In most cases, it's clearly best to enter more of a position when that position is down. So an example here is obviously you buy a stock, the Apple stock at $100, it drops to $90. If you liked Apple at 100, you're definitely going to like it at 90, and so you would buy another share. Well, now your two shares have an average cost basis of $95. And so then when it goes back up to 100, if you just had your one share, you would be breaking even at that point. But now that your cost basis for the two shares is $95, you're $5 in the green per share, so you're now up $10 because you bought that second share. So clearly, you would need to still believe in that stock or that position in order to want to do that. So obviously there I stated that when the stock goes up, that's a easy means of increasing your profits. But the next bullet point here is to be cautious when you're averaging down. Don't do it based on emotion or convenience because you have 100 shares of this stock and you don't really know what else to put it on. So I'm just going, and it's down, drastically down. And you have an extra $1,000, you're just going to throw it all at this losing position. That's not a great idea. You can be dumping it down the drain, throwing it at a lost cause. In a lot of cases, it's better to just close that position that's losing, move on with your life to other opportunities instead of waiting for that opportunity to turn around. Now, I'm just as bad as anyone at actually listening to that advice. A lot of times I'll be insistent that I want to win that position, but averaging down can be a means of increasing your odds at winning that position. So what I'm saying here is instead of basing it on emotion or convenience, make sure you base it on fundamentals. You love the company or the ETF, or there's some technical analysis. The chart is telling you something. The indicators are all pointing the same way that it will increase, but maybe you enter just a little bit too soon, and so you didn't time the bottom the best. Obviously, nobody does. So you're just capitalizing on that move down a little bit. In many cases, as I just said, averaging down, scaling, can be the difference between a winning and a losing trade. So if you were to consider having infinite amount of funds and every single time you bought, we'll go with Roku, which is a little bit more of a volatile stock compared to Apple, at least at the moment. Every time it dipped, you completely doubled down. So even if it continued to go down and down and down and down, we'll say every $10 down it went, you doubled down, you purchased a double of what the stock you had. So you had 100, then 200, then 400, then 800, a legitimate double down, not just adding to your position. Eventually, Roku is going to have an up day, and they will get to a point where you'll be able to exit profitably. I mean, unless it's a terrible company that's going bankrupt, obviously in that case, it's not going to make a difference. And in fact, that goes back to what I was saying before, where you're throwing good money after bad and into a losing position. But in the tickers that I like to trade, the leaders of the industries, the best stocks out there, doubling down is typically going to allow you to take a losing position and turn it around. So I especially think this is relevant when we're talking about long-term holds like index or ETF funds. If you never intend on selling them, or obviously not for many years, averaging down can never hurt. So in my IRA, I have some SPY, some IWM, all of the different ETFs that you would expect a person to have. I have some of all of them, and anytime I have some extra funds and I can throw into the IRA, and then I wait for the ETFs ideally to have a dip, and then I buy in. Although if enough time passes, it's very likely that you're not going to be able to average down. You'll still be averaging up, but that's still not a bad thing. You can't really time the market, and in most cases, it's just better to continue to purchase those ETFs. But my point is, if you do see a dip in those ETFs and it's below what your current cost basis is, that's a great time to buy, because ETFs, especially unless it's a dying industry, will also go up over time, and so then you'll be able to recoup your money that way quicker. I do have a caveat here with options. It's not always the best idea to scale into that exact same position unless it's only a day trade or only for a couple sets of contracts. So what I'm saying there is, in a day trade, you're going to open up a position and it might quickly go against you just with the natural ebbs and flows of the market. So then you're going to double down on your contracts, and now you have less room for it to move up that's needed in order to exit profitably. That's a very common scenario. We just did that today with SPY. And the other thing I'm saying there is only for another couple sets of contracts. So say I'm using the strategy of a put credit spread, and it's 45 days to expiration. And I have one contract, and then literally the next day the stock goes down. But I still think that that position will be totally fine in the number of days I have to expiration and then the strikes that I chose. Then maybe I'll just get another contract or two to increase the premium, net premium that I collected on that position. But the whole caveat there is you still have to believe in that position for that exact strikes and date to expiration. In many cases, it's better to consider lower strikes or a further dated days to expiration position. So obviously, if Amazon goes down, today was their earnings, they did particularly bad reaction wise. If it goes down, I'm not going to jump into the exact same position that I had prior to earnings, because that was at a much, much higher level, and the amount of recovery we need to do in the next couple days is not realistic. So that, again, would be throwing money after bad. You have to consider, would you enter that position today, right now, if you didn't already have an existing contract? And if the answer is no, then you shouldn't be doubling down. But if the answer is still yes, then by all means, that can be a great idea to add a couple contracts. Okay, so this part is about scaling out of a position. The first slides were scaling into a position. And just a quick note here, Tasty Tracker, my website, allows scaling in and out of stocks and options. I do think that is a critical component of any strategy, or it should be. And so I wanted to make sure I had support for that. So scaling out of a position, this is especially relevant if you hit a home run on options. So you're day trading options or short swings. So you have some long calls or puts. Typically, people are buying 50 contracts of, GameStop and of calls. All right. So say GameStop moons, you want to close out a couple of those contracts in order to cover your entry costs to get into that position. And then from that point on, you could consider it to be market money. However, that is a fallacy that I could get into in a later video. That money is still yours and still real. So you should definitely consider exiting some or all of that position. But at the very least, you want to exit enough to cover what it costs to enter that position to begin with. Then you can let some runners on. Those would be contracts still out there, or some stocks still out there, depending on what you're doing, that you let to try to maximize your profit on that position. So just as an example again today with the SPY lotto that we had, we exited with a small profit, and then we sat there and watched it continue to go up. Had we had more contracts and more faith in that position, we could have entered one or two contracts and then another two contracts as it went up another $10, and then another two contracts as it went up another $10, etc. So letting those runners on there is a great way to maximize profit, because as time passes, you can get more comfortable with where the trajectory of that stock during that day. So I do occasionally do this for stocks, indexes, ETFs that have had a nice run. So say there's a range, or maybe you're using Bollinger Bands or something like that, and you can tell sort of the upper band of that range, whether it's a horizontal range or even a slanted range. You can tell a lot of times when a stock is getting close to having a pullback. So I might trim back on my position. Say I have 100 shares of Apple. I might trim that back to only have 25 shares of Apple. So I'm still in the position. I'll still reap the rewards if they continue to run up, but I'm anticipating that they're going to have a little bit of a retracement. So I'll exit 75 of those shares, bank some of those gains, trim back my exposure so that if they do have a huge pullback, I'm not completely crushed. I can use that money that I already banked and pulled out of it, sat on the sidelines, to enter it back in at a better price. So it's kind of the best of both worlds. You can let it run a little bit if it continues to run up, and then maybe it runs up another $50, and I'm convinced that now is the time it's going to have a pullback, and then I'll exit out of the last 25 shares, and I'll just be out of it until it does reset. So obviously the caveat there is timing the market doesn't always work. So that's why it's nice to keep some of those in place. But at the same time, the market doesn't completely go straight up. Obviously, it has down days, and usually the patience pays off where you can get back in at a cheaper price. Now, the question is, if it runs up so far up, the pullback might not be significant enough to offset just leaving your shares in, if that makes sense. So say Apple now goes up to $200 and it has a massive pullback, but comes back down to $150. Well, that's still $50 higher than what I entered in at. So, you have to play this by ear. You win some, you lose some. Part of it's experience, part of it's luck. But yeah, just a general idea there. So the last area is sort of switching gears here. Before it was scaling in and out of a position, whether it be a stock or option position. This one is actually about scaling a strategy. So if you have a large account and you're trying to buy a large amount of shares, you need to be careful with the low float stocks. That is, stocks that don't have a huge outstanding number of shares available to be purchased. So first of all, I have a note here that if you're trading with a group and you're all purchasing the same stock and it's a low float stock, you will definitely move the stock, and you just need to be aware of illegal activity that's purposefully pumping and dumping stocks or publishing false information, those kinds of things. I'm not an expert on that, so you can do your own research for now. But the idea to take away here is there's a limit of the number of shares that you can get, the quantity, before you start driving the cost up, and then anything you purchase beyond that, you're just driving the cost up for yourself to own more shares. So the best way, especially if you follow some of these big gurus, is they'll continue building a position over a number of days or weeks or months even to get, they'll just have a buy order, and they'll keep picking off a couple thousand shares as it has its dips, but not so many shares that it totally blows the price out of the water. So you can't trade the same with $100,000 as $100,000 as $1,000,000 on that low float stock. You need to have different strategies in the way that you purchase and scaling in. If you have $1,000,000 account, you're going to need to scale into that smaller low float stock in order to keep your cost basis from going out of whack. And then just a fair warning, the low float stocks come down as quickly as they go up. So, when you're talking about pennies, that's usually what the low floats are. You're dealing with something that is very volatile. So, anyway, when you're getting to the point where you can no longer scale in a position effectively, options are obviously a great alternative to stock, and it's much easier to scale, especially if you're talking about something that's heavily traded like SPY or SPX. There are so many contracts traded per day that you can really get in and out much, much quicker. However, because options are leveraged, obviously that can burn you quicker. If you have stock, especially if you're trading SPY, it's not going to go anywhere. It's not going to go to zero enough that you'll blow up your account. Obviously, if you're putting $1 million into options, you run the risk of that going to zero. So that's your fair warning. Plenty of other videos about that. But spreads get increasingly harder to fill. So if you're talking about having, opening up 1,000 long calls on SPY, that's easy. Now, if you start talking about doing spreads, that's two contracts, the long and the short contract, on a more obscure stock, even if it's something like Best Buy, especially if those strikes or one of those strikes is very far out of the money, with very little activity on that strike, that's going to be harder to fill. And if you're day trading these options, that's really going to get in the way of your profitability. Your broker is going to show you the price that spread is trading for at the moment when you go to close out. But when you put in that number, say, okay, yeah, I'll accept that number. It doesn't actually close because there aren't enough people there to fill that when you need it. So definitely spreads are, that's why a lot of day traders don't do spreads, because it's just harder to get that fill in. But obviously you need spreads if you're, depending on your style of play, I guess. If you're talking about a really, really expensive stock like Amazon, that's going to be really hard to not do spreads. So that's why those don't typically work out for day traders, but obviously some can do it. So an alternative to scaling in and out of spreads or options in general is to just do a much wider spread. Again, you have to be cognitive of the activity on those strikes, how much open interest there is in volume on those strikes, in order to make sure that you can get in and out. Of course, you don't know when you enter it what their open interest is going to be when you exit it. So, just beware of that. Naked short or short calls and puts take a lot more collateral. So using those can be a method of trading on $1 million account, a large account, where you eat up more of your collateral, more of your cash account, and then you're not tempted to potentially put on a lot of other trades and blow up your account. Obviously, still possible. And then the last thing you can do to sort of scale, all of these are altering your strategy a little bit. So, take that in mind. But the other idea here is to use higher value tickers. So if you're playing Amazon and Microsoft and AMD and Nvidia, these are all $50 to $200, $300, $400 stocks. If you get into Amazon and SPX, which SPX has other tax benefits, you might also want to consider as well. That can eat up more collateral because they are higher value stocks. Obviously, with Amazon, you can get a spread that is much, much wider than you could on something like Twitter or something like that. Okay, so that's really all I had today. If you had any thoughts or questions on something I didn't cover, let me know and I'll answer them in the comments below. Give a like and subscribe if you could. I have a lot of people that actually view the videos but don't subscribe. I have all my links in the description. I have charts on Twitter that I do almost daily. I have a Discord server, and then I have my website, tastytracker.com, which is free to track your trades. Also see the community's trades that they've published, and then I have my own pro alerts if those are something you're interested in. Other than that, here's my disclaimer, and I'll talk to you next time. Thanks.